This is Repositioning Analysis for Apartment Buildings, Wealth Creation through Syndication. This is the second video in our series. The first video is Introduction to Repositioning Apartment Buildings. Please view that video first, as this video refers to several slides in that previous video. My name is Jeffrey Smith. Standard disclaimer: the information provided is for general education purposes only. I'm not a lawyer, I'm not an accountant. If you need such advice, seek the services of a competent professional. This is not a solicitation of investment securities. Objectives: determine repositioning costs, analyze the operating data, calculate the pro forma after repositioning valuation, structure the repositioning financing. Hypothetical Case Study 1. Highland Residence Apartments. Not its real name, not its real picture. This is a completely made-up case. The intent is to explain the basic parameters of financial analysis for a repositioning project for an apartment building. We're assuming this apartment is a garden style with 65,000 square feet and 78 rentable units. Repositioning analysis. This is from the previous video. 12-month project. We're guessing at 2.5% of the maximum allowable offer as the acquisition closing costs, and we're guessing at $1,200 per unit on average for the cost of repairs. This property has some down units, and other units require some light rehab. The main problem with this property is poor management. We add in a 15% contingency factor and get a nice round number. Total repositioning costs $127,000. This number will be fine-tuned after the property goes under contract. That's when you bring in the general contractors, at least 3. They will walk every unit in the property and make a scope of repairs cost estimate. You will then choose the general contractor that you want to hire to do the repositioning after you close on the property. Operating data. This is from the previous video. We have actual operating data on the left, how it's running now, and pro forma operating data on the right. This is how we anticipate the property will be running after the repositioning effort. You'll notice that the actual net operating income, $137,000, is a very good 6-figure number that can service high-cost private debt. And the net operating income on the pro forma side shows that we've increased the net cash flow by about $60,000. If this property were being valued at a 10% cap rate, that's a $600,000 increase in value. Income valuation basics, the structure and cost of financing. These equations are very important. The annual mortgage constant, AMC, loan-to-value ratio, LTV, leverage to price. It is the debt margin divided by the equity margin. Loan-to-value divided by the quantity 1 minus loan-to-value. This is the leverage that you're getting on this financing structure. If it's 80% levered, then you have 80% divided by 20%, which is 4. Leverage to price is 4. That means for every dollar invested in the property, the lender is providing $4. Annual debt service is the debt present value times the annual mortgage constant. And when you take the annual debt service and divide it by 12, you get the monthly payment for the mortgage. Debt coverage ratio. This is probably the most important number on this slide. It is the net operating income divided by the annual debt service. If you calculate the reciprocal of the debt coverage ratio, you get the debt coverage margin. This is how much of the net operating income is dedicated to debt service. And the cash flow margin is 1 minus the debt coverage margin. That's the ratio of the net operating income that goes into the owner's pocket. Debt yield. It's the debt coverage ratio times the annual mortgage constant. It's also the net operating income divided by the debt present value. It represents the yield to the lender if the lender makes a loan today and then forecloses tomorrow, wipes out all junior liens, and then receives the net operating income. This represents the return, the yield on the investment. Capitalization rate. It is the debt yield times the loan-to-value ratio. It's also equal to the net operating income divided by the maximum allowable offer, or the value of the property. Gross return on equity. This is also called the cash-on-cash return, the cash-on-cash yield. It is the quantity debt coverage ratio minus 1 times the annual mortgage constant times the leverage to price. Leverage to yield. This is the return on equity divided by the capitalization rate. It is the multiplier on the cap rate for the cash-on-cash return. It's also equal to the cash flow margin divided by the equity margin. Debt present value is the net operating income divided by the debt yield. Maximum allowable offer, or the value of the property, is equal to the net operating income divided by the cap rate, which is also equal to the debt present value divided by the loan-to-value ratio. Now let's derive the capitalization rate. We start with the debt coverage ratio, the annual mortgage constant, the loan-to-value ratio. These three values determine the capitalization rate and the cash-on-cash return, the return on equity. Net operating income, NOI. The annual debt service is equal to the debt present value times the annual mortgage constant. The debt coverage ratio is equal to the net operating income divided by the annual debt service. The maximum allowable offer, or the value of the property, is equal to the debt present value divided by the loan-to-value, which is equal to the net operating income divided by the capitalization rate. So we start with the annual debt service is the net operating income divided by the debt coverage ratio. The debt present value is the annual debt service divided by the annual mortgage constant. The maximum allowable offer, or the value of the property, is equal to the debt present value divided by the loan-to-value. Thus you can see the capitalization rate is debt coverage ratio times annual mortgage constant times loan-to-value ratio, which is also equal to the debt yield times the loan-to-value ratio. You can see that we've started with the net operating income, we divide by the debt coverage ratio, and then divide by the annual mortgage constant, and then divide by the loan-to-value ratio to arrive at the maximum allowable offer, or the value of the property. Therefore, these three numbers, debt coverage ratio, annual mortgage constant, loan-to-value ratio, when multiplied together, determine the capitalization rate. The debt yield is calculated as the net operating income divided by the debt present value. If we substitute for debt present value, we get the annual debt service divided by the annual mortgage constant. And now substitute the annual debt service as NOI divided by debt coverage ratio. And then invert reciprocal. We now have NOI on the top and bottom of a division, so they cancel out, leaving just debt coverage ratio times annual mortgage constant is the debt yield. How do we calculate the annual mortgage constant? Use a spreadsheet or a financial calculator that uses positive dollars received and negative dollars paid out. Set the number of periodic payments per year. Some mortgages are paid 12 times per year, once a month. Some are paid quarterly or semi-annually. So set the number of periodic payments per year. Set the fully amortizing term, the number of payments to fully pay off the loan. Then set the interest rate. Set the future value to $0. This is fully amortizing. Set the present value to negative $1. $1 going out, $0 coming back. And then calculate the periodic payment. Then multiply the payment by the number of payments per year to calculate the annual mortgage constant. It's also called the annual debt constant or annual yield constant. All right, now that we know how to calculate an annual mortgage constant from given loan parameters,